Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're having a good day wherever you are. As you know, we have been probably the most early alerting economics research firm around over the last 12 months, warning of so many negatives that would soon be looming. And we were doing so at a time when everyone else was incredibly optimistic about the Nirvana economic outlook. And we don't mean to be negative. In fact, I'm being incredibly positive because I see how with today's modern financial instruments, we really can manage our risk and even maximize the opportunity that's there in declining markets as well as in rising markets. So with that said, it was interesting to see the IMF coming out and agreeing with our forecast that we really were mentioning 6 to 9 months ago, and it's taken them quite a while to play catch up, but they have been playing catch up to their credit. I remember when they last boosted their GDP forecast for the world and the world's major economies, that was about a year ago now. I said, well, they'll soon be unwinding those forecasts, and that's exactly what has happened. The IMF is now currently forecasting 3.2% GDP growth for the world this year. That's no change from their previous forecast of a few months ago. Remember, the IMF and the World Bank, they tend to adjust their forecast to reality as time goes on. They're not really an over the horizon forecasting outfit. So always see their forecast as confirmation of what a lot of people were already expecting. What was interesting that they downgraded their forecast for 2023 to 2.7% GDP growth. Now, this should be alarming to just about everyone because the IMF is a conservative economic calculator and forecaster. It has a lot of people to keep happy, so it tends to be conservative about what it's saying. 2.7% might sound okay for a national economy, but when you're talking about the global economy, which has been growing at 4.5%, 5.5%, 6.5%, 2.7%, that's a real worry, a real serious concern. Within that they have now a very similar view to myself, which is that the three largest economies in the world are indeed in trouble. I don't see China as being so much in trouble as having a permanent reset to a lower trajectory of economic growth moving forward in the order of 2 to 5%. In other words, China has now become a mature capitalist economic system. Remember, it's a one-party democracy, they would call it, in terms of a government system, but it had really shifted towards a capitalist system, and given all the red tape, regulation, compliance and everything that is required in Western economies now in Europe and the United States, some economists, myself really sort of alerting people to this as well, China in some ways had become the more laissez-faire, pure capitalist economic system for a period of time, which is why it had such tremendous economic growth over the past 2 decades. That sort of capitalist economic system freedom, which saw that tremendous growth, is certainly being wound back in recent years with more and more state intervention obviously occurring, but nonetheless, the economic growth stature that has been achieved has set China now on a sustained path of being a massive consumer society that is going to be growing at levels that are akin to how the West used to perform several decades ago in the 2 to 5% growth range. In terms of Europe and the USA, the outlook is not so rosy. The outlook for Europe is in fact bad and getting worse. Unfortunately, my warnings about, and you may remember I do this not because these are things I want to have happen, these are things I see happening. Remember, I wrote an article, an essay prior to the war starting when everyone thought, no, Russia won't invade Ukraine. That was the popular view then. There would be no invasion, was the popular view. I wrote a 5-point essay on 5 reasons why Russia will invade Ukraine. Because of the Russian perspective. You can't make a decision about what a country is going to do unless you consider the perspective of that country itself. Now we're in a situation where, unfortunately, recently over the last several days, particularly, but from probably a week or two ago, but I've intensified my warnings that there is risk of an intensification, I called it, of the conflict in Ukraine, with the potential for some spilling or expansion of the conflict. And that is exactly precisely what we have unfortunately begun to see. Now, the more this happens, the more intense the conflict, even if hopefully it is confined to Ukraine, and that is becoming more and more problematic by the day. But if it can be confined to Ukraine, the intensification of the conflict within Ukraine is just going to do further damage to consumer and business morale across all of Europe, again putting a downward pressure on economic growth, which is why for some time I've been forecasting a dark recession in Europe. I still see that happening. On the other side of the Atlantic, we have the United States of America, and they have already been in a recession for the first half of this year. So negative growth for a whole half year, with people pointing to jobs numbers, but I won't go into that again. I've done that quite a lot. But I see the risk of a depression for the United States in 2023. Now, the IMF listed a whole lot of factors, and they're fully known to everyone. But people have failed to factor these in as being real world that will in fact impact Main Street economies everywhere throughout the world. That is higher food, higher energy prices. And by the way, energy prices are most likely going back up as Europe requires more and more of the world's natural gas. Natural gas prices will again be climbing. If there is any further intensification of the war in Ukraine, oil prices can be expected to rally as well. And we know that it isn't a world united against Russia, as we're often told. It really is only Europe, the United States, and Australia that are united against Russia. Why I say that is in the Middle East, as we're seeing, they are very happy to continue to price oil as they feel appropriate by global demand levels, not by what the United States would like to see in terms of supporting their push against Russia. So South America, Africa, Middle East, Asia, not so on board with this idea of being anti-Russia, which is why the Russian economy is doing quite well. The ruble is quite strong. And we can expect that to continue to be the case. However, the sanctions applied to Russia are extremely harmful to the European economy and are having a spillover effect to the United States. But the United States really has its own story, and that is massive hangover effects from all the stimulus measures and low interest rates for too long, the Fed not recognizing inflation getting out of hand, and then the Fed following up with far too aggressive interest rate hikes against inflation. Also, their natural gas prices and oil prices being driven up by the conflict, by the increased demand from Europe. So the US economy is in a lot of trouble. And for the consumer in the United States, right now, not only have they seen their equity and share market portfolios decline rather savagely, they are now seeing property prices begin to fall as well. And when you get both those sectors falling at the same time, that really does dampen consumer enthusiasm. So I see consumer and business retrenchment starting to gather pace in the United States over the next 6 to 9 months. I see it just intensifying in Europe itself. So overall, no, it's not a good economic outlook. My own forecast, IMF's forecast for global growth next year are 3.2, 2.7. My own forecasts are that this year's global growth could be as low as 2.7, maybe 2.8, but probably 2.7 immediately this year. And next year could be 2.4, 2.3%. We're not going to see a global recession, But we are going to see a recession in two of the world's three largest economies, Europe and the United States, and we're going to see a permanent slowing. We have already seen, and we are in a permanent slowing of the Chinese economy. I noticed that Goldman Sachs recently said China's economy is going to boom once it comes out of COVID lockdowns. Well, no, it's not. It's a new world where the Chinese economy has reached a maturity where there just isn't that room for tremendous growth rates that there once were. And we also know that the Chinese property bubble is also bursting, which is interesting. So you're going to have property prices falling in China, the United States, and Australia all at the same time. There's not going to be a lot of investor enthusiasm out there to speak of. So be very mindful, stay very active with your own investment portfolio. And as I've said, since the first week of January this year, play good defense with your investment portfolio, and the financial tools to do so are certainly there. Thank you very much. Have a great day.